Today property is stolen through pen and electronic means as evidenced by various financial scams during 2008 crisis. The financial crises of 2008 or Great Recession is considered the worst economic crisis since the Great Depression. Now over a decade later, are we heading again towards Great Depression? There are several signals which indicate that we could be on the verge of an economic meltdown. Financial crises in general are pretty similar, for example dot-com bubble and 2008 economic crisis. The next global crisis might take place in a similar way. We have multiple bubbles that are quite big and might burst anytime in the future, such as student loans, U.S. corporate debt and derivatives market. What is a yield curve? Yield curve is a graph charting the rates on treasury bonds. Slope of the yield curve gives an idea of future interest rate changes and economic activity. There are three main types of yield curve shapes: normal, upward sloping, inverted, downward sloping, and flat. The curve normally steepens in a growing economy because investors demand higher yields on longer-dated bonds in case inflation rises. An inverted yield curve reflects a scenario in which short-term debt instruments have higher yields than long-term instruments. Typically, long-term bonds have higher yields than short-term bonds. An inverted yield curve is often seen as an indicator of an impending recession. Should we be worried about the yield curve? Yes, because it inverted for the first time since the 2007 financial crisis, warning that investors expect an economic slowdown. It shows that the U.S. is headed towards a recession in 2020. That's the message from a widely monitored bond market yield curve. Fed officials from Alan Greenspan to Jay Powell watch it closely. But why is it so important? Going by historical data, the significance of an inverted yield curve in predicting recession cannot be ruled out. In March 2019, inversion of the yield curve hit 3-month T-bills for the first time in about 12 years when the yield on 10-year notes dropped below those for 3-month securities. That metric reverted and then inverted again in May and is now trading at negative 36 basis points. Counter-argument is a recession may still be a year away. And not everyone agrees it to happen. But bond market gyrations are already threatening to bring down stocks globally.